Well, welcome to today's podcast. I'd like to welcome Matt Cialella from MC Rent Roll Brokers to talk to us about the importance of rent rolls and how to make sure that your rent roll stacks up and gets the best value, and possibly discover some hidden opportunities for some real estate agents that have not really thought about the rent roll and the value of the rent roll, and how important that can be as part of their strategy and in their business and career in building. So George Sabados and Matt Cialella, welcome today.
Thank you,
Thank you.
Barry.
Thank you, Barry.
Hi,
Great to be here.
Matt. What interests me immensely are the numbers behind businesses. That's something that really lights me up. And what I understand from my experiences over the years is that most people are financially illiterate, and I imagine the same goes for a lot of real estate agents. They might be very good at selling, but may not understand necessarily the value of a powerful rent roll and how the numbers shift significantly if the percentages change a little bit, or you get maximum efficiencies out of your rent roll. So we'll get into that in a minute. But before we do, how did you get into this line of work?
Yeah, good question. Thanks, George. Look, I did 10, 11 years in banking at Macquarie Bank, and that held me in good stead to then embark on my next chapter. Sort of got to the point where I realised after 10, 11 years, I wanted to do something for myself. My father was self-employed, Italian heritage, always did things for himself. So it was there somewhere bottled down in the recesses of my body, and it just came out at 11 years, and I had to go out. And my experience was working with real estate agents in the banking sector at business banking, and very much specialised looking at P&Ls, balance sheets of how real estate or property services businesses work. But I used to get approached by people like myself saying, Matt, have you got a rent roll in a certain suburb? Or not a rent roll, but have you got a client that wants to buy a rent roll in a certain suburb? And I'd go, oh yeah, sure. Take it to the team, sit down, we'd discuss it, and we'd potentially find a client for the broker that would approach me. So I went, well, hold on, I can do this, and I can put a model around it whereby it's not just about, buy, sell. It's about the whole complete process transition, because there's so much more involved with a business in selling, but buying a business, there's so much more. It's not like buying a property. And there's people that are inside it that behave, and they are so critical and pivotal to a rent roll, the people. If you don't have good people, you really don't have, you can have an okay rent roll, but you're not going to get your bang for buck and be able to grow it and get some really good profitability or metrics out of it. So that was me 8 years ago setting up this, and it's evolved, and here I am now.
Yeah. So tell us about some of the numbers. I guess because you are a numbers man. How does it stack up? Like, how does the model stack up for people who want to purchase?
For people that want to purchase, look, there's some real key metrics. So when I'm putting together a memorandum and I'm taking a rent roll to market, I've got to think with two hats. I've got to think, well, okay, my vendor, how do I best put his or her rent roll forward? But also, how do I make it attractive for a purchaser to want to look at this opportunity? And it does, you're right, George, it's the numbers, because really you have to take the emotion out of it. However, I'd honestly say 9 times out of 10, there's emotion involved in the buying process. But you've just got to look at, well, I'm looking to buy one for the first time. What do? Well, you've got to look at your own rent roll first and come to a conclusion that, does it make sense to grow it organically or to acquire? And I think everybody who's listening would also understand that you get to a certain point where you're going out and you're doing business development, and it's just, you're hitting a wall and you're not getting that traction. And it is more competitive now on price, management fees, and the landlord does want more, the legislation. So acquiring is a good strategy to get that real injection of cash flow into your business. So first thing I always say to people that are looking to buy, don't go and buy a rent roll that's going to be at the detriment to your existing rent roll. don't look at what your existing metrics are. So if you've got average annual income of your rent roll per property of say $1,500 per property, well then don't go and buy a rent roll that's generating $1,000 per property. All you're going to do is drag the averages down and make it less profitable. That's the critical thing people seem to forget. They just get caught up with, oh, I'm going to go and buy. But look at if your rent roll is better than the one you're looking at, you should be buying this. You should be looking at one that's equivalent or better in terms of the numbers that are staring at you on the page.
Now,
that's
Matt,
a really good point.
In retail, Matt, that's called the average transaction value, but in food and bev. But what do you call it in the real estate game?
The valuers put a bit of an acronym on it called AAMI, which is average annual management income. And that's critical because the banks look at that, and the banks look at the average annual management income per property. So, for instance, I'm New South Wales, I'm Sydney based. If we look at Sydney, you need pretty much $1,500 per property per annum in pure management income, right? If you've got less than that,
is that net?
That's net. So that's not your letting fees. That's not.
Right.
That's not your admin sundries or your others. So that's just pure management income. And if you've got less than that, then you've got to start looking at why.
Right. So these companies that are popping up charging, $100 a month, that's $1,200 a year, and there's other ones popping up saying they'll do it for 3% management fees or 4%. That can have a significant impact by the sounds of it, and not in proportion to the valuation by the sounds of it. Is that what you're saying? Yeah.
So I look at, say, for instance, Sydney CBD. The average rent for Sydney CBD is probably about $900 per week. So you can have a rent roll that's probably 4% on average, but your rents are good enough to get your double AMI to be at 1,500 or 2,000 or more. The eastern suburbs is a good example where, if an eastern suburbs rent roll is less than $1,500, you're saying, oh, well, okay, there's something wrong here because the rents are significantly higher. So you'd expect an eastern suburbs rent roll to be $2,000 per property per annum. So that's fine, having an attitude of looking at lower percentage, but your rents have got to be there. You can't do 3% in Blacktown. It's just, you're going to lose money very quickly.
So Matt, what you're saying then is if anyone listening would look at their rent roll and just divide the number of properties they have by the revenue.
Yeah.
Sorry.
Correct. So total.
Yep.
Total management income proposed.
Yep. So how does that?
It's got to be proposed because you've got a rent roll. If you manage 150 properties, but you've only got 140 that are lettable, well, you've got to look at proposed because you should be quite possibly trying to let out 150 properties. Got it.
But how does the value, for example, of the rent roll change significantly for every $100 that's short of the 1,500 double AMI, or how much added value is there for every $100 above that?
Yeah. So the $100 is, George, it's neither here nor there. It then comes down to a question of, well, how does it change downwards or upwards? It then becomes a question of, let's look at the other metrics. Okay, where are the properties located? And let me give you an example. If you're an agent that's in Surrey Hills and pretty much within a compass point at your office, and you drew a circle and you did 5 kilometres and you've got 200 properties under management, and pretty much out of those 200, 160, 170 are within that radius, you'd say, okay, that's a normal rent roll for an inner city office. Now, those other ones that are outside that are 20, 30, 40 properties outside, okay, where are they? Well, if they're managing 20 in Campbelltown or 30 in Penrith, well, that's a problem. And that detracts the value because all of a sudden you've then got to separate the Campbelltown, separate the Penrith, and start putting lower values on them that are reflective of a rent roll in that suburb, increasing it proportionately. You cannot say, oh, well, I've got a rent roll in, for instance, Drummoyne, and then I'm managing 30 properties that are sitting over in Double Bay, Paddington, which are much, much higher. A valuer is not going to walk in and go, whoa, we're going to put $4 on those. but the rest of the Des Moines ones, we're going to put $3.80 on it, you're pretty much going to sit them around the same mark. It's only when you're looking backwards, when there's inferior properties, that you look to bring the value down. So it's just a question of the geographic spread. And then secondly, it becomes a question of what's your owner concentration, because the banks will look at, and valuers will look at, what we call an average of about 1.3 to no more than 1.5 properties per owner. That's a good number. So, and that's basically how many properties versus how many landlords.
Why is that important, Matt, for those people who don't understand?
It's important because if you have quite a few landlords that own 10, 20, 30, and they decide, I've got some properties, and use the Surrey Hills example, I've got some properties in Campbelltown, you know what, I'm going to put those with the Campbelltown agent. Well, you could probably argue, well, they're only going to move those to Campbelltown, right? Might be a bad example, but if that owner moves all of them because they're not happy with the service, well, sorry, if they move one of them, they're going to move all of them. So that's there you go. You're going to lose a significant amount of income. So the banks now and the valuers, and they're instructing valuers to separate those larger owners. I can't tell you at what point do they start asking them to separate. It depends on the breakup. You really have to look at, well, if you've got two owners that own 8 properties, some banks might go, okay, let's look at that a bit more closely. But also, it's not just how many properties each owner has, it's the income. Because
so it's the income, it's how many properties they have, but also, Matt, if for example, there's a rent roll of 400 that an agent has, and only 2 of his landlords have, in excess of 10 properties, but most of them have 1 to 1.5.
Yeah.
That's, I'm guessing that in the eyes of the bank would be considerably less risk than if he had 20 landlords over a rent roll of 400.
Yeah, correct.
Right.
Yeah.
So so you don't understand the formula then. What you're saying then is you don't know what kind of formula that the banks have to review that risk management.
Well, all I know is that the banks, for instance, will turn around and say, well, what's your average?
Yep.
Okay, if it's 1.6, if it's 1.7,
yep.
Right, okay, now let's look at your top 10 owners.
Gotcha.
Let's separate the top 10 owners. Let's look at how many properties they own, and let's look at the income that they generate.
Yep.
And that's how they would look at it.
So for anyone wanting to build a rent roll, what you're saying then is don't have 80% of your revenue coming from 20% of your landlords.
Yeah, correct. Don't go for the low-hanging fruit where
right.
the developer that you've done some work with turns around and goes, oh, I'm going to hold on to some stock. Can you look after these 20, 30 properties, but can you do it at 3%, please?
Sure. That's one aspect of how you value a rent roll, but how much does it hurt the value of a rent roll to find that, that someone does have, let's say, 20% of their landlords generating 80% of their revenue?
Look, it's an issue that you've got to start looking at how are you going to de-risk. You have to look at how you're going to de-risk that. It really is a critical, because at some point in the near future, that relationship won't stand the test of time. There'll be factors outside of we've got a good relationship that those properties will move. It's more than likely. And normally those properties are attached to the principal. They're not normally attached to a property manager. Those bigger concentrated properties with one owner. So, you've got to start looking at, well, let's put the risk of the rent roll into more spread across the office with our property management team. Because if you can have 400 for your example, and you've got a team of say three property managers, and you work to a model which allows you to have property managers covering for other property managers while they're on leave or sickness or whatever, then you're de-risking the whole portfolio.
Yeah.
Right?
Does it make a difference, Matt, for how the portfolio is managed, whether it's based on a portfolio basis or a task base, because there seems to be a few different ways that rent rolls are managed. Have you noticed there being a difference in how they get valued?
Look, it's not a factor for valuing, and it's not a factor for arriving at price, but it is certainly a factor for if the buyer or purchaser works to a pod model and the vendor works to a more portfolio-based model, then you've got issues, because it's like going from property tree, doing a data merge from property tree to property me. You're not going to grab all the info. It's going to be an issue, and it's going to be a lot of work. So that's a factor in the transition piece that you have to take into account, but it doesn't have a factor on value. And if that purchaser says, well, I'm only going to pay 30 cents less because, well, I turn around and go, well, no, that's not fair. That's not fair on the vendor, because the metrics in the rent roll are still profitable. It's a still great rent roll.
Right. And what would you say is the percentage that you see of people running it via a task base versus a portfolio base?
Look, I could be wrong, Barry, so please don't quote me on this, but I see more probably task-based if I had a look at it. But I'd have to go and have a look. I'd have to look at all the previous sales.
We won't hold you to it, Matt. We can't hear you, George.
My apologies, everyone, for muting myself. Matt, normally when we look at a product-based business, we look at the operational expenses of the business that impacts the bottom line, and then there's a multiple applied to the bottom line. In the case of rent rolls, generally speaking, if it was a conventional product-driven business, the bigger it gets, the more operational expenses you have, because it's labor intensive.
Mm-hmm.
And therefore, it doesn't necessarily change the valuation greatly. But in the real estate game, rent rolls are valued on top line, a multiple of top line. Yep. So what are the factors that shift the multiple that you apply up or down on that top line that our listeners could consider for themselves?
So the double AMI is the one that I pointed out at the start.
That's the big one.
That's a big one.
Right.
So you've got your double AMI. You've then got probably your owner concentration, again, the average owners per property.
Yep.
Right. That's another one. And then thirdly, the geographic spread.
Yep.
Right. And then look, the actual management commission, I don't get caught up on, and the reason why I don't get caught up on it is because it gets looked after in the double AMI, because it's all relative to rent versus management commission. They're probably the three that really I think you've got to take a close look at, but you've also got to look at the one most important one that I haven't discussed, which I think is just critical, and it's what are you paying your staff? What are their salaries? Yeah,
well, that was going to be my next question, because obviously operational expenses are critical to the management of the valuation of a rent roll. I would think. I'm looking at it from a traditional outside of the real estate industry perspective. If, for example, I'm buying a rent roll over from a super efficient operation where they pay lower than average salaries to their management staff, I'd be trying to build in a bit of a safety margin there for myself, knowing full well that I generally pay my staff more, and they're not. And the systems and procedures I have in place are not as efficient as what I'm buying. Do they impact upon the value placed on a rent roll? Those considerations.
Yeah, they do. They do. I mean, I'll give you an example. At the moment, I'm dealing with a rent roll that I'm selling, and it's 190 properties. It generates 190 properties. It generates about 270,000 per annum. and there's one property manager attached to it. There is an assistant, but they're pretty much spread across the office doing marketing, sales, as well as property management. But the salary for the property manager is like 100K. And this is where you create a rod for your back, that if you've got somebody that's getting paid a lot of money and they're very senior, well, somebody that's buying 190 properties already has a team in place, right? Most often. And if they're doubling their rent roll, they're pretty much going to need to take that property manager with them. But if the office that's buying has one or two property managers that are on $70,000-$80,000 per annum, and you've got it. Look, honestly, you've got a big gorilla that's on 100. That's a tough one. Yes, my vendor can argue that, oh well, they're senior, they could run the whole team. But now you're starting to dictate political terms and cultural terms to a buyer, and you can't do that. So one of the conversations I have really early with a vendor is, well, you do realise that this could be an issue. So we've got to look at some point, we've got to have a conversation with that staff member. And it's normally after we exchange, because you've got to understand that these things are kept confidential all the way up to an exchange point on a rent roll, and you're not telling the actual staff member, you know, what's going on. You're trying to keep it secret. So what you're going to have to do is look at, well, how can we be creative? How can we then offer incentives to build back up to the 100, which allows them to earn what they've always been earning? Otherwise, we've then got a problem, and that is that the purchaser still wants to go ahead with the transaction, but they don't want the property manager, and they want a longer retention because they're worried about the properties possibly going to another office or with that property manager that goes elsewhere. So then you're delving into a myriad of issues outside of what you're trying to achieve with the transaction. So it plays a big role.
Yeah, look, look, out of all the rent rolls that you've come across, how do you?
We've lost you again.
Hello.
Sorry, I missed that, George. Sorry.
Okay, I was just saying, of all the rent rolls that you've come across, are there any that really stand out for you, and what were the qualities that stood out for you?
Are there any that stand out?
That really stood out for you? They were absolutely exceptional, outside of the norm, and why so?
It's a good question. It's a really good question. I tend to only take on opportunities that I really feel have a good chance of going to market and getting success with. You know, I've never had the mentality of just list everything and see what happens. You really have to take a real good deep dive into the business and the rent roll. But no, actually, you know what? I've got a good example. There's one at the moment that I've got, and one of the best things about it, and this is a really, really good sort of not trick, but it's a good best practice for an office to adopt. And that is that one of the things that stood out when I went in and spent 2 hours after hours, having a look at some of their files, having a look at how they do property management, because in all my memorandums, I paint like a one-page summary of how they do property management, what's their process, because I think that's important. What was fantastic about this was that they had a pack for a landlord and they had a pack for a tenant. The pack for the landlord gave them an RP data, 3 pages on their property, rent, how they're positioned, all those things, and it was fantastic. But the pack for the tenant was also really good. This is what to expect. This is what we're going to do, and it was a 3-4 page pack. I don't see a lot of offices that have these really, really good packs for their landlord and for their tenant. Now, why I say that? Because it just means you're doing that extra bit. That's what landlords really, really like. And that will come home to roost when you sell. And that will give you stickier landlords that will basically stay with you. As much as a purchaser wants a rent, they should want a rent roll like that, because that's what you need to aspire to be doing in your office.
I'm actually surprised you say that, because recently did my Real Estate Institute certificate registration and course end of last year. And they were banging on about that, like kits for the tenants and kits for the landlords as part of the property management module that I was being taught. And it's surprising. It shouldn't surprise me because I've dealt with a lot of small business owners over the years, and out of I would say over 1,500 as a minimum, and I could say that fewer than 10 had business plans.
Yeah.
So it doesn't surprise me. It shouldn't surprise me, but it is surprising when it's being taught and everyone talks about it.
Yeah. Yeah. Look, and it's a good point because it just means you've got a very organised office. It means you've got a good ship. You've got staff that are following procedures, and it's what fair trading want, and it's why we've got when I say fair trading in New South Wales, it's why we've got a new act which is trying to tighten up how we operate as an industry and how we operate as a profession. You want to be delivering better service.
Matt, from your experience though, how does a suburban office, for example, if they had, let's assume they had an unlimited number of landlords willing to throw them their properties, how do they gear up for 1,000, 2,000, 3,000 properties without losing the plot?
How do they gear up?
In your opinion, how would an office run a very efficient management or around properties in the number in excess of 1,000?
Yeah, it's a good question, and I sold one last year that was about 1,200, and I looked at it, and again, it starts, and I say this a lot to people that a fish rots from the head. You've got to have a really good management structure in place, and you've got to have layers that essentially mean, you effectively can have a really well-run office. And it goes back to the best practice. If you don't have what like a manual, if you don't have something where you're employing staff that come in for an interview and go, this is how we do our business, it's all in this pack. Go away and read this and come back tomorrow and I'll give you an interview. Now, you need that. You need to be able to put something in front of your prospective employees and say, well, this is how we do business here, and this is our mantra, your culture, all of those things. When you walk in through the front door, you see some offices and they say, these are our office 5 things that keep us as a happy, harmonious team. That's a start. So if you've got 1,000 managements, you have to have a real clear goal and a real pathway. But you've also got to have clear goals for how staff can aspire to get into more senior roles. I look at, for instance, some offices that I know are the larger ones. They have a shareholder buy-in. The bigger they've got, well, hold on. If there's 2 or 3 of us that own 1,000 managements, how are we going to sell this? How are we going to sell 1,000 managements in 5-10 years' time? That's a tough proposition. Well, if you've got people buying in, your buyer is your staff. You sell down to your staff. So as you grow and get to such a large size, you've got to have that attitude of we've got to share this with the office. But you've got to have clear things or metrics that the staff have got to meet in order to qualify to buy into the business. So you then got an attitude of loyalty, and you've got an attitude of culture and an attitude of best place in business to work. So for 1,000 managements, you have to have a really humming machine and a harmonious team. And then the rest is really, well, got to have a good head of property management. You've got to have your weekly catch-ups, your monthly, your quarterly, your annual. Those things just flow on. But I think it starts with having the right culture and the right people.
That's a good point, Matt, about the size of the rent roll. What's the sort of typical size, which is, I guess, for going to the market with to sell? Like what I'm hearing from what you're saying there is 1,000 or more becomes more challenging.
Yeah.
But what sort of number is it? Is it 500? Is it 200? Is it 250? Like, is there a number where it's like a sweet spot if somebody's I guess even looking to package their managements up into separate companies. What would you say there?
I think it comes down to, as soon as you get into a certain price point, you're going to the bank and you're getting funding from the bank. It's like trying to sell the most expensive property in your suburb. Your pool of buyers shrinks. Not as many people have that money. So then you have to really look at, well, how are we going to be able to sell this going forward? And that becomes a question of, well, how can we have a business that is going to keep growing, but is liquid at the same time? And yes, you touched on it, Barry, that you've got to have the company structures where you start parking portfolios by geographic spread into different entities. Yep, that's one strategy. But on the whole, the price point, say getting to 500 managements, you are getting to a point of well over $2 million, $2.5 million. The buyer needs bank funding. And right now, that's really hard. That's really hard because the banks have tightened up on their lending post-COVID or during COVID, because they're just taking a very blanket view that when we get to the end of September, JobKeeper rolls off and a lot of these businesses will fall off a cliff. Not so much financially, but we're going to see some cracks. We're going to see some earthquakes, some tremors. So they're expecting a tough December quarter and a tough March quarter, a lot of the banks, because we are going into the busiest time of the year, which is the last quarter of the year leading into Christmas, but it's a very different December quarter. But also we are going to have a quiet March quarter.
Okay.
A lot of people are going to be tired after all of this year.
Well, I imagine that given the exceptional set of circumstances that have permeated through the economy in the last 6 months, and the bank position on lending at the moment, I imagine that's affected the multiple that you apply to a rent roll. Surely.
Yes and no, George. I'm seeing some rent rolls that I'm doing deals on now that I sort of dropped at third week in March when it all happened and picked up again, because we went, oh, okay, that wasn't so bad. We're back to some sort of a normal market again. So you pick those up again and you re-engage with people. And yeah, I'm seeing a little bit of shaving of the price. To be honest, I like this market. I'm not dealing with people that are just ringing up to say, yeah, I might buy a rent roll. I'm dealing with people that legitimately want to buy something. It's a market where you're dealing with honest, sincere buyers or honest, sincere sellers. So you cut through with conversations is better. So prices have come off a little bit.
Yeah, I guess someone with your experience as well, Matt's going to be really valuable in this market, because you based on your 8 years of knowledge in doing this, you're going to know what are the things that somebody has to really look for, whether they're looking to buy or sell. Your expertise around that, and probably getting in touch with you before they're maybe ready to sell it, like just to get you some ideas on what they need to do to prepare it.
Yeah.
I can see you got so much knowledge there that it'd be really valuable for anybody watching this and thinking, yeah, I'm either going to sell or buy, just to start cluing themselves up on what to look for.
Yeah. I mean, the first thing that comes out of my mouth when people ring up about a rent roll opportunity is, okay, funding. Who are you getting your funding through? How are you paying for this?
Yeah, very important in the context of where we are today.
Yeah.
How does that affect the LVRs now? So, like, I guess what we were hearing about 12 months ago, Matt, was maybe the banks were lending 50 or 60% in some cases on rent rolls, maybe even 70% in some when the market was really strong. How has that impacted the LVRs for banks? Are you seeing?
Well, the banks are sort of looking at it and saying, well, we just can't drop our LVR across the board, because if they did that, then they've got to apply the LVR that they're putting on purchases to their existing portfolio. So then you've got a problem. You've got an actual problem within your own portfolio that you're managing. So you have to take a short-term view and say, well, okay, any new-to-bank customers or any existing bank customers that are buying a rent roll, the banks are saying, well, what we'll do is, if you're buying $1 million and you want to get 100% purchase price, we'll take 15% off that. So we'll give you, yes, our LVR is still 60%, but we're giving you 60% of 850, not 60% of $1 million. So what's the end result? Probably a 48, 50% LVR, not a 60% LVR. So people just have to be aware that they're going to have to put some more hurt money and equity into a transaction if they want the banks to really approve them. But cash flow more than ever is king, and it's about how you're servicing that debt.
And is there any minimum, Matt, for what banks would look at? Like, can an agent with 40 properties go and have a loan or something against their rent book? Or
Look, no, Barry. You can't. The short answer is no. The banks are taking the view that they want meaty transactions. If they're going to go to credit, and if they're going to go to credit and sit down with credit on why they should do this deal, they want to do a meaty transaction and they want something worthwhile. They're not prepared to just take anything to credit because, I'll be brutally honest, credit are running the banks at the moment, not the sales team. So they're on the back foot when they go to them to begin with, and they're putting deals forward that the bankers are earning their money at the moment. They're really having to show their true value on why they should do a deal with somebody.
Mm-hmm.
Matt, look, in business, there's always swings and roundabouts, and we move from an aggregate model, putting everything under one roof, and in the modern context, certainly the younger generation, they truly have accepted the outsourcing model. Have you seen any rent rolls that were managed on an outsource model where there was really very little for the property managers to do apart from liaise with landlords?
The outsource model is an interesting one, George. I mean, there's a lot of agents that are bigger or have large rent rolls are utilising the Philippines at the moment to outsource a lot of their, I suppose, those tasks that a property manager gets bogged down with. They're not income generating, just administrative tasks, reports, ingoings, outgoings, routines, putting all the repairs and maintenance work out to tender, those things. So I'm seeing that, but a property manager still has to deal with, what's happening with that property in the suburb they're in, right? Sure. So that's what a property manager is dealing with. But they're also dealing with, the repair work to some degree with the conversations, and they're having to deal with, I suppose, growing the rent roll organically and trying to get more properties out of that landlord that is a good source, and getting referrals. So the outsourcing, I don't see the larger businesses going full blown into the outsourcing model, because I think, as we've seen through this COVID times, everything's been brought back in-house. I think we're going to see a little bit more of that, to be honest. I think we're going to see, hopefully, more of that come back into Australian shores, and we're going to get more people getting jobs in that, in the industry. But the outsourcing model is one that, when I look at some of the players, like you mentioned at the start, the ones that are doing the model of $1,000 flat rate, monthly rate, they've captured or grabbed that model a bit more, because I think they have to, because they're trying to cut their costs and keep themselves lean.
Well, we've heard about those models. What feedback we're getting, Matt, is that they're struggling because they don't have the staff here to manage all the tenant issues.
Yeah.
And that's having an impact on customer service, and the landlords are feeling like they're not getting communicated with. The tenants are getting a blanket response. So in some cases, I've heard of just some companies just trying to give everyone their tenants a discount and instead of a bespoke experience, because they just don't have the people there.
That's so right, Barry. And I think this is the best opportunity in this market we're in right now to really show to your landlords what your true value is. Go to them with more, go back, because let's be honest, the sales have dropped off, right? So your rent roll is so critical, important right now. So you should be getting your salespeople to work with the property management team, helping them out and getting them to provide more, because there's your opportunity right now. Your customers are in front of you.
Well, and we're seeing that, and we're also seeing that there's a way to outsource where if you if you are outsourcing to the Philippines for mundane jobs and what have you, you don't want them communicating with the landlords at all, because what we've heard feedback about that is that it can turn off your landlords, and we've actually had that experience ourselves where we were doing that a little bit and it wasn't working. So what we've had to do is restructure who's coordinating, who's liaising with who,
Yep.
and really make it a personalized experience. And we see our, the property management side of businesses being in the business of bringing peace of mind for landlords and tenants and everybody, even the staff. So we're also seeing that the staff that are paid a little bit more are able to build better relationships with the existing landlords, and that's bringing more business into the business. So it's delivering a better experience for everybody. There is still a place for offshore pieces, but you've got to be very careful from what I'm seeing about who you engage in that.
And I think that's a good point, because I think what I've heard is that a lot of these outsourcing opportunities, not opportunities, but you train up somebody in the Philippines and you got this great person that's doing a great job for you, and all of a sudden they might move on to another opportunity, and that means you've got to train someone else up. So I think you can't go into it with just having one dedicated person. You've got to get to a point of scale where you go, okay, we've got enough to employ 2, 3, because then you've got coverage, and then it's probably worthwhile.
Well, it's a very important point, Matt, because de-risking the model at every step is critical to any business. You never want any particular individual to have a chokehold over the process, because if they get hit by a bus or disappear or move on, it's all over Red Rover. And and it's it's something that I've noticed that not many business owners across the board give much thought to.
Yeah.
Is that the kind of advice that you give people when you come?
Absolutely.
Yeah.
Absolutely. Yeah.
And what kind of actions have you advised people to take in order to get around those chokeholds?
Yeah, I think the same way you look at your business and look at the staffing and look at how you are in your business, how you staff your business, and how you have built that element of culture into your business. Well, if I've got somebody that's been working with me for 20, 25 years in my business, and there are a lot of agencies out there that have got career people, they're going to want to move on at some point. Well, how am I de-risking that situation? And the only way to really look at that is, well, you've got to have, when it comes back to what I said before, you've got to have an element of, we've got to build a culture where people want to work with us. And if they're working with us and they're happy with us, they're going to come to us and they're going to talk to us when they've got problems in their life, and they're going to share with us. So we're not going to get hit by by something on a Monday morning. Oh, I'm leaving. I'm moving on. I'm not really happy. So if you're close to your staff and you're close to what they're doing in their personal lives, in some, within reason, you're going to have your finger on the pulse. And you're not going to get those things that happen, people hit by a bus or move on, so to speak, that are going to create big, wreak havoc in your business.
But as we know, Matt, a lot of people who own a business, they're not necessarily savvy in that way, right? They're barely holding on themselves. There's so much to do. There's so much administration, management of staff. Sometimes for a lot of people becomes a secondary issue to what they're dealing with daily. If
you can afford it, George, then get somebody to do it for you.
Yeah, right.
Because a lot of us are salespeople. A lot of us are good at communicating and talking.
Correct.
A lot of us aren't good with numbers. A lot of us aren't good at managing people. Like I'm probably somebody that puts my hand up and said, well, how would I go managing a team of 5 people? That's hard.
To borrow is something from a page of Rich Dad, Poor Dad. Kiyosaki keeps talking about, technicians that have this moment of madness where they decide to, set up a business, and they're not They're not business owners. They're not entrepreneurs. They're technicians, and they get caught in this whole world of hurt where they have to be all things to all parts of the business. And people management is one of the most complex, difficult parts of managing a well-oiled business, and often owners can't handle it.
Well, it's not considered that value either, George. Like, I think the distraction value that the cost of being distracted has on your overall business and the efficiency of a team. So what are your thoughts on that, Matt?
Yeah, you know what? I was just about to say the best rent rolls I've sold, and it probably answers your question from earlier, George. The best rent rolls I've sold are the ones where the business owner has been someone that's not working in the business.
There you go.
Right, they're the ones that sit above. They're the ones that sit above. Yeah, they could have worked in the business 15, 20 years ago, but they're the one with the string. They're the puppeteer. Yep. They're the one that are pulling the strings and calling people in. They're the ones that are dealing with, and the ones that the ones that are trying to grow by acquisition are the ones that are going out and dealing with those decisions and just focusing on that, and then letting the rest of the business run itself.
Yeah, got it. Well,
I'd like to talk about just something on another matter. Like, a lot of real estate agents that we speak to, Matt, especially sales agents working at companies, they don't really value, they don't know how to value, and I don't think they're really looking at the value of the assets they're bringing. So, for instance, we spoke to an agent this week who refers about 30 managements a year to the company that he works for, and he might get a couple of $100 or something per management. But what do you see that as being the real value for them? Like, we've talked about a lot of different things on how to value, but to put into some context for a sales agent who may be watching this, to go, okay, what is that worth if you're finding 20 or 30 managements a year and the average rental, say, $600 or $700 a week, and the fees around 5%? What sort of value and businesses are they looking at, potentially creating for themselves as a backup, like you said, if the sales comes down again, to have some sort of insurance bet?
Yeah, look, I think, and I'm not going to quote the models that are doing it out there, because there are a couple that are doing this model, and that is that if you've got salespeople that are referring 20, 30 properties a year, you should be setting up a separate entity and parking those properties into that entity and saying, well, you know what, there's your rent roll. You know what, we've grown this together, and giving your salespeople an opportunity to grow their own asset within your business. That's really a good strategy, because all of a sudden you've got people that are going, well, hold on, I'm not building the principal's rent roll for his super, or her super. I'm building something for myself here.
That's a really good idea, Matt. But I know the person that Barry's referring to, and it seemed ludicrous to me that there wasn't even much thought given to the value of what he was doing. No, he was giving away a golden goose.
Yeah, that's like, I'd be grabbing that person 20, 30 a year. I'd be grabbing them with both hands and holding on to them.
Yeah.
Because what's 100 properties worth? Let's have some spitball rough figures here, Matt. If it's let's say they're bringing in $1,500 a year each one, and there's 100 of them. What's that rough? And it's around the in a metro Sydney area. Roughly, what's somebody looking at for a value of that?
So that there's straight away 400, possibly $350,000 to $400,000 asset.
Wow.
It's look, straight away. That's in 3 years, for the fellow that Barry was speaking of, he could be sitting on 400 to 500 grand worth of.
Sorry, actually, it's more. I'm just doing the numbers, and I'm not a very good mathematician. It's more. It's 500 to 600,000. It's actually more.
That's a bit worrying, Matt, that you're not a good mathematician, given that you were in finance.
My wife does all the maths homework with my year 10 daughter.
Thank God for Excel spreadsheet formulas.
Yeah.
Yes. So it's a lot, right? It's a lot. So in the case of this particular agent that Barry was mentioning, within 3 years, he'd be sitting on over $500,000 worth of assets, and that's amazing. And he's giving it away.
Well, that's the superannuation, right? That's a really good, healthy superannuation package for an agent. You look at an agent who works 10 years, and there's a couple of $1 million as a super payout Particularly in sales, agents are not, if they leave their job or they can't work for some reason, the money stops, the income stops. So
Yeah.
Well, I'm just wondering how many other agents are in the same, like, think the same way and behave the same way, because that would be frightening to know that there's many of them out there just giving away
Yeah, agreed.
their future, really.
Yeah. Yeah, 100%.
well, it's been great speaking with you today, Matt. I mean, you're an absolute wealth of information, and particularly around rent rolls and how to structure them and how to build them. And I think if anybody's wanting to think about building their business, it makes sense to speak to someone like yourself and or sell them or buy them, and just get an idea. And obviously, then you guys can be in contact and you can connect them with suitable sort of roles. So, what's the best way for somebody to get in touch with you, Matt?
So they can either shoot me an email at matt@mcrrb.com.au or give me a call. Go to my website, www.mcrrb.com.au. Contact details are there. There's some really good articles that I've written over the course of the 8 years on strategies. I've got 10 things to consider when looking to sell. I've also got another one on things to consider when purchasing. Look, I'm happy to help as much as I can, Barry, and I appreciate the opportunity. It's been great.
Great. Thanks, Matt. I've always found you very helpful and approachable every time I call and ask a question, and you're probably thinking, oh, this is a question you've already asked, or it's a silly question, but you're really great about it. And just to be clear, MC Rent Roll Broking, so it's MCRRB, stands for MC Rent Roll Broking. So just so the
it's
listeners
just too
know
long if I... So look, and it's been great talking to you as well, George.
Yeah, thanks very much, Matt. I mean, I will. I'm sure I'll be asking a few more questions of you, maybe privately offline. But
sure.
I guess, look, there is one more thing before we go. Do we have time, Barry? Just one more.
Yeah.
One more question. So rent roll. I mean, it's obvious that the rent roll is where the value is in a real estate agency. How much value do you place on the agency after you take out the rent roll?
Oh, that's a really tough one. I think that it's once you take the rent roll out and the people have gone with that rent roll, well then
it's all over.
Really, it has to be a big humming sales machine to get some good value over the top of the rent roll value. And over the years, a lot of people were saying, I want something for my office, I want something for the brand, I want something for this. And that's a tough one, because I'm not one to sit there and judge and say your business is worth nothing, your brand's worth nothing, because that's insulting. You've put your heart and soul into it for years, but at the same time, the person that's buying it, that's already got a brand, they're not going to put necessarily the same value and emotional value on it that you've put on it.
Matt, you're absolutely right. It may be insulting, but people walk into businesses without understanding the consequences of their exit.
How many restaurants do you guys see that are sold, and you hear through people in the street that, oh, they sold it for this and wow and this and that, and then all of a sudden, the first month they're not open, they're gutting the place and changing it from Italian to Thai or something, and you go, what the heck? What have you done?
Yep.
I just don't understand that.
I don't get it either.
And there's a good example in an industry where the people that run the restaurant are it. That is why people walk through the door, because they love the owner coming and talking to them. They'll get they'll get a port, they'll get a free dessert. Their kids love it. It's just that. There's your value. It's really
consistency.
Hard.
Yeah. Consistency and all of that.
Thank you, Matt.
Thanks, guys.
Thanks, Matt.
Great.